Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Well, the unrelenting marketplace just keeps on screaming up, currently on its longest winning streak in the S&P 500 since October of last year. And if we'll go back to more time frame here, let's pull up kind of just the last little bit of data from last year. As you can see, last October we had a really big run up from the 30th of September all the way through the first week in November before we finally got a retracement back down. This one we're running up from from right around the 12th of February up until the 21st of March. We're up in terms of time frame wise a little bit more than we were in October. Something very similar spurring the activity though. As you can see, the market is responding very similar today as it did in October because, coming out of the drop in the price in August, September of 2015, there was a lot of news that the Fed wasn't going to raise rates because the market was so skittish. People are nervous. People were nervous, people were scared, and you're kind of seeing that here as well as the market's coming down. Mr. Old Bullard from the St. Louis Fed gives a speech here. Bullard gives a speech from the Fed here in September as well. Bottomed out the market in September, bottomed out the market in February, and it's almost like this is a song and dance routine that the Fed's been playing with the market for the better part of the last 15, 16, 17 months, and I think the market's very frustrated with it, quite frankly. We want some clarity. It's almost like, but even if you look back to 06, 07, 08, 09, especially in 08, 09, if you never would have started, if you never would have started ZERP, if you started TARP, if you never would have started all those asset nine horrific bailouts of the rich that didn't need to be bailed out with consumer money, your money in this predicament today. But much like the government and the Fed, they both can't see the forest through the trees, and they can't see, 6 to 12 to 18 months down the road. If all these things to happen naturally, then the bear market could have already been over by now, and we'd been picking up the pieces, building bridge roads and infrastructure, and we could be starting down the next path of the bull market. But because of this uncertainty here, neutrality and uncertainty in sideways marketplaces is a better place to be than in a down market or whatever the case might be. I don't believe that the Fed can be that much higher unless they announce massive quantitative easing. You cannot keep the market up simply by talking to it, Mr. Bullard. You cannot keep the market from tanking simply by using only 2 interest rate hikes instead of the 4. That's just gonna, that's the calm before the storm to a certain extent. But that's the underlying philosophy. That's the underlying belief system behind the market movement in this, in what I would consider a fairly historic run, even though we did go one just October and into early November. The market does not move typically a good 10-12% retracing. That's kind of what we drove here. Double top, came right back down, and to me, it's very difficult from a price action perspective, because even if we want to buy in, there's certainly stocks that not invest in. It's what are we supposed to? I mean, as an investor, as a trader, am I supposed to buy at the top of a 10-point movement in the market when they historically don't move 10 points? That's not all well and people are going to do. That's not what traders are going to do. That's not what the real investors are going to do. Just for the opportunity for the Fed to stop so they can get out of long positions and re into short positions. But who am I to talk about traders when all we care about these days is the Fed? So in terms of looking at this, the Fed did have a very important economic report last week with monetary policy. They maintained monetary policy from last week in terms of basically the interest rate at 0.5. However, they did lower the projections of a 2%, only 2 interest rate hikes instead of the 4 that was expected, and then clockwork, just like every other damn time we've ever faced with the Fed. They say one thing one week and come out with speeches literally almost the exact next week. They come out with speeches out of St. Louis, not St. Louis, but San Francisco. They come out with speeches this week and late last week. Oh, don't worry about what we said Wednesday. Worry about what we're saying here. And it's just like the market is over you, Fed. And I hope you guys get this video because I'm going to tell you something very, very clearly right now. Central bank presidents, Chairperson Yellen, Bullard from St. Louis, nobody cares. Nobody cares what you say, what you do. You're a bunch of clown shoes. You were fairly respected economist until you started manipulating everything in the world. You were fairly important economist until nobody can at your work. You tell things to everybody. You literally change your mind every other week, if not the same week. Janet Yellen, you are one of the worst central bank presidents in the history of the central bank, and that includes Ben Bernanke, whom I feel is the most manipulative central bank president since in the last 40, 50 years. But you put a policy out there just in December of this year where you said the economy was on target. You said unemployment had hit their targets and inflation was going to eventually hit their targets based on your policy actions. And because the market freaked out to you, you came off that. And then when the market freaked out a second time in February, you came off that again. And now a short 3 months later, after you started lifting off, a short 3 months later, after you changed 9.5 years of monetary policy, you have seen enough economic data to change yet again. I do not know who is a bigger blowhard, a bigger conformist, or just an outright liar, you or Donald Trump. And I hope you listen to this recording eventually, Janet Yellen, because you are losing all credibility. You are losing 100% credibility amongst all economists, amongst all traders, amongst all institutions, amongst all hedge funds, because you cannot change the monetary policy of the United States in a 3-month time frame, 16 different times, and expect the world just to sit back and let you play global economists, let you place theory in a world that has real impacts. And it is an absolute joke. That's my soapbox for the market recap video. Usually I save the podcast, but I'm very upset about this because even just last week, we came in with basically this monetary policy saying, oh, no, we're very concerned about the economy. We're very concerned about this. This is 3 months after they were saying they were very okay with all of this, and there was only going to be 2 interest rate increases throughout the rest of the year. And then you have literally 2 speeches today, speeches late last week, where the Fed is talking about raising interest rates in April and that the economy is doing okay. And it's to the point where we need to exile the Fed, and we need to all band together, come together, and exile the Fed. And until we do that, we are never going to get outside these bubbled marketplaces. We are never going to get outside the random craziness to the marketplace. It is going to be a constantly manipulated marketplace, and it's going to be a market dominated by professional traders, which in my estimation, okay, fine, I'll take the bait on that, Jenny. But what about mom and pa? What about my father? What about my mother? What about my wife's parents? What about consumer America? What about the people that work their ass off for 30, 40 years to save up enough money through their retirement accounts, 1Ks, savings accounts, money market accounts? What about those? What about all of the baby boomers whom you literally have destroyed through your asinine monetary policies of manipulation? In my estimation, what you have done is criminal, and you shouldn't. But unfortunately, there's no oversight of the Fed, because when you were created illegally in 1930, create your illegal cartel that we call the central bank fractional banking system, there's no government oversight of you. Well done, golf clap. Now enjoy your high mountain and your dark cloud with your iron thorn. For the rest of us, we're going to get back to the market recap video. Outside of that, we did have some news today. Starwood, we talked about Starwood Hotels last week in the market recap video, and Starwood's in the news yet again today. Last week, as you can see, it gapped up with a revised bid from a Chinese conglomerate to purchase Starwood properties. There are 1,300 properties. Their competition is obviously Marriott. Marriott came in today, upping the ante, and oh my goodness, Starwood. If you're an investor in Starwood, just in the last month, you've went from 70 up to 85. That's a nice little 35% movement in the last couple weeks. So Starwood, looks like Marriott and Starwood are going to make their deals done. Sherwin, we also had some other merger and acquisition news here. Sherwin-Williams getting just absolutely blasted today for their Valspar merger acquisition of over $12 billion. Obviously, people think they're paying too much in terms of fair market value for Valspar. Valspar obviously gaps up on the news. Let's show you Valspar here. Gaps up from 85 all the way up to 105 before you start seeing some profit taking, and rightly so, as looks like Sherwin-Williams is going to be taking at least a 45% cash position in the purchase of Valspar. That is a big time cash position for something that a lot of people, including myself, might be a little too much, but we'll see in terms of that, as obviously the market loved it for Valspar and not so much for Sherwin-Williams. Tesla, my favorite, and yours. Tesla Motors got a nice little upgrade today to a buy position, driving the market up about 2.4%, up 5 points, up to right now rock solid $240. If I was an investor in Tesla, this is where I'm writing cover calls, adding protected put options, or locking in some gains. Tesla off from 140 up to 240, literally all in the last month and a half. Just an absolute, amazing last month and a half for Tesla. I do not foresee that continuing in the short term. And this goes for a lot of stocks at the higher levels of the market right now. Once they get to so far overextended as Tesla Motors zone, yes, got good news. Yes, it can run, but for how long? Do we really think it's going to run from 140 to 300 without a pullback? Maybe not. I'm going to say it's not very probable. That's why you buy products against it. That's why you buy put options if you're an investor. Tesla right now, so that you can lock in those gains. The difference between a good trader and a bad trader, or an average trader and a bad trader, a great trader and a good trader, is knowing when to write a call against something, knowing when to add protection against something, and not just letting it just go to, just throw it up to caution in the wind to a certain extent. Let's look at a couple real things very quickly. The dollar in a nice little bearish trend. It is overextended to the downside. I do expect to pop back up on the dollar, maybe into 96. The talk of the Fed raising rates in April definitely helped the dollar today rally from the low points of last week, where it was getting butchered by the Fed, to rise back up a nice little 50, 60 cents today. I do expect that to continue in the short term up to about 96, as we last time it got this far overextended. As you can see, it went from right around 100 down to about 96, about $3.50 movement there. Here's 98.5, same $3 movement. You're talking somewhere around 95. That's right where it is here. That looks about the tail end of the extent of a downward move in the dollar from an average market cycle perspective. Expect that to retrace back down, but I don't see any reason why this bearish downtrend won't continue in the foreseeable future. Looking at the euro dollar here, love the double top on the euro. That looks like a little bit of an M formation forming, but you never know, ladies and gentlemen. You never know if it's the M formation, not until it comes all the way back down to 108. It could form a head. It could form a ascending triangle. It could form a nice little teacup called the cup and handle formation. But it does look like this is a potential shorting opportunity, locking in profit opportunity on the euro dollar. Looking at crude oil back up above 40 bucks. As you can see, historic run in crude, historic run in the marketplace. Can crude maintain? Can the market maintain? They are correlated right now. So if one goes up, the other one's going to go up. One goes down, the other one's going to go down. But for you crude investors, including myself, good last little month and a half in crude. Looking at silver showing a little bit of weakness, up around $16 a share. And finally, the VIX is undervalued underneath 15. If you have a retirement account, this is where you are looking to lock in profit. This is where you're looking to add insurance. Insurance is cheap when the VIX is low. Insurance is expensive when the VIX is high. Hopefully you enjoyed the market recap video today for March 21st, 2016. This is Matt Justice. We are Tackle Trading. Get in the game one trade at a time. TackleTrading.com.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.